Apple stock has been absolutely on fire lately. We can see over the past year, they're up 22%, and year to date, they are up almost 44%. Now, during this time period, they have been all over the news for a multitude of reasons. We can see they recently announced a multi-billion-dollar deal with Broadcom, which is one of my favorite dividend growth stocks. They also now have an Apple savings account, which currently has a 4.15% annual percentage yield, more than 10 times the national average. They've also recently announced that developers generated over 1.1 trillion in App Store ecosystem in 2022. And then of course we have the most recent news announced just over the last few days. Apple has unveiled a $3,500 virtual reality headset, which is the biggest product launch for Apple in nearly a decade. Now you have to keep in mind this is a company that has been growing for quite some time now. If we look at the past decade, you can see they're up over 1,000%. And obviously this is one of Warren Buffett's largest positions in his personal portfolio. Apple currently makes up 46.44% of his personal portfolio. Now the common theme that we usually hear about Apple stock is this is a company that is way overvalued. You can see we have a price to earnings of 30.21, currently trading at an all-time high, but you do need to keep in mind people have been saying this for a very long time now. Let's take 2020 for example. They hit an all-time high in August of 2020, trading at around $124 per share. People were saying the company was way overvalued at this point, but it has done nothing but rocket upwards since that time period. But the question we need to answer in today's video is Apple a good buy at its current prices? So to answer this question, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of Apple, and we'll be looking at a few different valuation models like always. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in the stock ticker Apple and hit enter, and you can see all this data is going to load in. We're currently looking at a 365-day change chart, so you can see again price has gone upwards for quite some time. Let's go ahead and zoom out and look at a 900-day change chart. I'll plug in 900 here, and you can see it's been a little bit choppy. Previously, it was close to that all-time high, but over the past few days, it did bump up just a little bit higher. If we come over here and look at the dividend data, we can see they're currently paying out 96 cents per share, giving it a starting dividend yield of just 0.52%. So yes, a very low dividend yield, but they also have a very low payout ratio, and obviously they grow their free cash flow and revenue at a pretty rapid rate year over year, so they have plenty of room to continue to grow their dividend over time. Analysts currently have a target price of about $180 per share. Institutional ownership actually not as high as I would expect it to be. And then we have a beta right at 1.3, so you will see a little more volatility with this company than normal. Now the first valuation that we're going to be looking at is Graham's valuation, and this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors, and here's the formula he lays out for us to calculate intrinsic value. So the first thing we need is our earnings per share, and you can see we have this automatically plugged in here. We then need our growth rate projection for the earnings per share. I'm staying in line with analyst expectations in this scenario, going with 12. We multiply that by 4.4 and then divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, this is sitting at 4.68, which is really going to drive down this valuation quite a bit, because you can see we actually come to an intrinsic value of $105.21. Historically speaking, this has been closer to around 3, I think. So when you plug in 3, you can see the intrinsic value does jump all the way up to around $164 per share. So current market conditions definitely driving down this valuation model quite a bit. But let's go ahead and move forward and look at our discounted cash flow analysis. Now, the idea behind our discounted cash flow analysis is we should be able to see what a company is worth based on predicting the future free cash flows of the company. Now, to do that, we need to look at the historical free cash flow for the company and project a growth rate for the future free cash flow for the company. So you can see our year-over-year free cash flow growth rates for Apple. The average growth rate over the past 2 years is sitting at around 14%, so really good free cash flow growth. Moving forward, I'm projecting a growth rate of about 10% to the future free cash flows of the company and to the terminal value, which is the sum of the future free cash flow past the year 2031. I then found the present value of those future free cash flows and added them together, added the company's cash and cash equivalents, subtracted out the total debt to get the equity value. Once we have equity value, we divide by shares outstanding. Now, the last time I analyzed this company, the shares outstanding was quite a bit higher. But one of the things that Apple has recently announced is they are continuing to buy back shares. They just announced another $90 billion share buyback. So again, that shares outstanding is continuing to decrease, providing more value for their shareholders. When we plug all this in, we come to a discounted cash flow price per share of about $190 per share even. So a really strong valuation with the DCF model. Now, the next valuation model we typically look at is the multiples valuation. Now, I don't think it's the best valuation model in Apple's scenario because there's really no company similar to Apple, maybe other than Microsoft. But you can see here the three companies I'm trying to use in this scenario just to get a general idea of how the market is valuing companies that are similar in structure. So we have Microsoft, we have Google, and we have Meta. We're taking their stock price, dividing by the earnings per share to get that price to earnings multiple. Now the average price to earnings for these companies is sitting at 41, but you can see it fluctuates quite a bit. So I'm actually using the median price to earnings in this scenario. We multiply by Apple's earnings per share, and we actually come to an intrinsic value of around $204.15 per share. You could argue whether or not this is the best way to value this company, but again, I'm looking at other companies that are tech companies that typically trade at a premium, and you can see, especially with Microsoft trading at a high price to earnings multiple, we come to a high intrinsic value for Apple. Now, the last valuation model that we look at is the dividend discount model. And again, obviously they have a very low starting dividend yield, but let's go ahead and look at it. So I plugged in the quarterly dividend payouts over the past few years so we can see how much they pay out each year. The year-over-year dividend growth rates is sitting at around 6.5, 7.3, 4.55, and 4.35. That's an average growth rate of about 5.7 over the past few years. Moving forward, I expect them to have a dividend growth rate of around 6%, discount rate of 8.5, and that really only comes to a dividend discount model price per share of $40.70. Now, obviously, this is not a good way to value the company. The company is still more focused on growth than it is on growing those dividends, so we're not going to be using it in this scenario. So when we jump over to our output tab, we can see the three valuations that we use. We have grams at 105, multiples at 204, and then we have a discounted cash flow analysis at 190. When we average all three of these together, we come to an intrinsic value of around $166.45 per share. Let's say we were to apply a 10% margin of safety, you can see your acceptable buy price sitting at around $149 per share. With a 20% margin of safety, you can see your acceptable buy price sitting at around $133 per share, meaning now is not a good time to consider buying the company. Now, simply looking at our acceptable buy price doesn't always tell the full story, and I think that may be the situation in this scenario. This is the largest company in the world that we're talking about. If we jump back over to Seeking Alpha, we can see they have a market cap of $2.85 trillion. So it is obvious they are going to be trading at a premium, but let's compare it to where it's been over the past 5 years. If we click on the valuation tab and simply look at this price to earnings again. Price to earnings, whether it's non-GAAP or it is GAAP, we're trailing 12 months versus forward, it's sitting at around 30. But if we look at this 5-year average price to earnings, it's sitting at a lot closer to around 24 or 25. So it is trading at a little bit of a higher price to earnings multiple than it has over the past 5 years, meaning it may be slightly overvalued at its current prices. For me personally, I would like to see the company come a little bit lower before I consider adding shares, but there is no doubt this company has continued to outperform the market for over a decade now. People have been saying it's trading at a high valuation and should come down for a very long time, but it just continues to move forward. Warren Buffett obviously still has a lot of confidence in the company, with it making up over 46% of his entire portfolio. So as for me, I don't currently plan on adding more Apple shares to my personal dividend portfolio, but I do still think this is one of the best companies in the world. They have an extremely strong brand, they have a user-friendly interface, they have great developer support, great supply chain and manufacturing expertise, they have phenomenal research development and financial strength, and most importantly, they have a very integrated ecosystem. Apple has created a tightly integrated ecosystem of hardware, software, and services that work seamlessly together. This ecosystem includes devices like iPhone, iPad, Mac, Apple Watch, and Apple TV, and services like the iCloud, App Store, Apple Music, and Apple Pay. The tight integration between these products and services creates a superior user experience and makes it difficult for customers to switch to alternative platforms. Those are huge strengths for the company and gives it a very wide moat, which is why I think a lot of people feel so comfortable adding to it at these prices right now. But there you go, there's a quick analysis on Apple. Go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. If you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. But with that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.